It is December 26th, 2025. While the world lingers in the afterglow of Christmas celebrations, with families savoring leftover feasts and unwrapping belated gifts in the quiet of post-holiday mornings, the global silver market has shattered into fragments that no routine can reassemble. Normal life persists for most, offices slowly reopening, markets stirring from festive slumber, people returning to everyday rhythms. But beneath the surface of the financial infrastructure, a violent rupture has occurred. The logs are unequivocal. The pricing mechanisms that once synchronized global supply have failed catastrophically. This is not speculation. This is the documentation of a market failure already in motion, where silver has breached $75 per ounce, propelled by a concealed crisis centered in China that exposes the system's fatal vulnerabilities. Welcome back to Markets in Context. I'm Kevin Huang. We don't just look at the tickers here, we look at the structural forces that the mainstream media is too afraid to touch. If you want to stay ahead of the massive wealth transfer happening right now, make sure you hit the subscribe button, tap that notification bell, and like this video. It helps us get this critical data past the algorithms that want to keep this information suppressed. The impossible event is this: silver's spot price surging to an all-time high of $75.14 per ounce, while Shanghai enters deep backwardation with prices nearing $80, compounded by China's export restrictions on raw bullion. This is not an isolated spike. This is a structural breakdown where physical scarcity has inverted the market's core logic, with spot premiums far exceeding futures, and export bans choking global flows. On this day after Christmas, as economies attempt to resume, the silver market accelerates its disintegration. The backwardation and export ban stand as the core anomaly, a lethal fracture in the supply chain that reveals the system's collapse. Everything, every price tick, every vault withdrawal, every policy decree, revolves around this one impossible convergence of forces that defies resolution. In a normal market, prices rise gradually, reflecting balanced supply and demand. Surges are contained by arbitrage, where higher prices incentivize increased mining output or recycling, and futures curves maintain contango to reward storage, with lease rates remaining modest to facilitate lending. Export policies support free trade, ensuring metal moves to where it is most needed, and funds dedicated to commodities trade close to their net asset values without extreme premiums or collapses. This is the foundational rule. Markets self-regulate through interconnected flows, preventing any single region's demand from overwhelming the global structure. But that rule failed today. Silver's spot price has not stabilized. It has exploded to $75.14, defying containment mechanisms. Backwardation in Shanghai has deepened, with spot prices significantly outpacing futures, inverting the curve and penalizing deferral. Export restrictions from China have not eased supply. They have severed it, blocking 60 to 70% of refined silver that once flowed westward. The UBS SDIC fund is not corrected. It has collapsed to its 10% daily limit, trading it at a 62% premium before intervention. The system engineered to balance such pressures has instead exacerbated them, transforming a demand surge into a permanent schism. Do the math with me, step by step, because the figures expose the fracture without mercy. Start with the spot surge itself. The global spot price ranged from $74.46 to $75.14 per ounce on December 26, 2025. Take the intraday high, $75.14, the daily variation, plus 4.67%. To quantify, assume a prior close around $71.82. $75.14 minus $71.82 equals $3.32 gain. Percentage: $3.32 divided by $71.82 equals approximately 0.0462 or 4.62%, aligning closely with the reported 4.67%. Now scale to year-to-date performance. Opening near $28.50 at the beginning of the year, the gain to $75.14 is $75.14 minus $28.50, which equals $46.64. Calculate the percentage. $46.64 divided by $28.50 equals approximately 1.636 or 163.6%. But the report documents 149%. Suggesting slight baseline adjustment accounting for trading volatility, yet the trajectory confirms the explosive 140 to 150% range extended throughout the year. Shift now to Shanghai's backwardation, which represents the heart of the physical crisis. The Shanghai Gold Exchange benchmark hovers around $80 per ounce. Subtract the Western high. $80 minus $75.14 equals $4.86 premium per ounce. Calculate the percentage. $4.86 divided by $75.14 equals approximately 0.0647, or 6.47%. However, sustained readings push to higher effective dislocation when factoring in currency equivalents and physical delivery costs that compound the gap. For a single 1,000-ounce bar, the mathematics become even starker. Western valuation places it at $75,140. Shanghai valuation reaches $80,000. The gap stands at $4,860 per unit. This unbridged difference signals the inversion that defines backwardation. In this condition, spot exceeds futures by margins that dismantle hedging strategies completely, with Chinese traders paying substantial premiums for immediate metal over deferred contracts that promise future delivery. Now examine the export ban impact with precision. China handles 60 to 70% of global refined silver flow to the West. Take the midpoint of 65% for calculation purposes. If global refined supply reaches approximately 1,000 million ounces annually, China's share amounts to 650 million ounces. Current restrictions block this flow entirely, creating an immediate Western deficit of catastrophic proportions. Subtract this volume. 650 million ounces restricted equals a direct shortfall equivalent to over half the annual mine output from all other sources combined. The UBS SDIC fund collapse demonstrates institutional panic materializing in real time. The fund fell by its 10% daily limit, dropping from a 62% premium above net asset value. Work through the premium mathematics. If the net asset value stands at $100 per share, the fund traded at $162 before the collapse. The 10% limit collapse wipes $16.20 per unit at the maximum allowable decline. This regulatory intervention caps speculation in theory, but in practice it amplifies scarcity signals by confirming that even dedicated silver investment vehicles cannot sustain their valuations without underlying physical backing. Geopolitical layers compound these structural breaks with additional pressure points. The Venezuela blockade adds measurable risk premium to precious metals broadly. U.S. sanctions on tankers and trade routes spike silver as a geopolitical refuge asset. Calculate conservatively. If the prior risk-free price stood at $70, adding a 7% geopolitical risk premium equals approximately $74.90, remarkably close to today's baseline before the final surge. Japan's defense budget expansion to $58 billion creates another demand vector. Electronics manufacturing for military applications absorbs additional ounces from an already constrained supply. Estimate the impact at 1 to 2% of global demand uplift, small in percentage terms, but substantial in absolute ounces when markets operate at the margin. The numbers interlock with mechanical precision, refusing equilibrium at every junction. The system logs affirm the anomaly beyond any reasonable doubt. The escalation unfolds in distinct layers, each break compounding the last, turning a single anomaly into a cascade of irreversible failures that feed upon themselves. Understanding these breaks individually reveals how they combine into an unstoppable force. First system break. Backwardation has gripped Shanghai's futures curve with unprecedented severity. Spot prices, near $80, tower over futures contracts trading at lower levels, inverting the structure where immediacy commands premiums that no deferral can match or overcome. This break dismantles the hedging foundation that global markets rely upon, as traders in China forsake future promises for present metal, draining local inventories to decade-low levels and pulling global flows eastward without any reciprocal westward movement. The curve inversion persists day after day, week after week, signaling not temporary tightness, but structural shortage. Second system break. Export restrictions have sealed China's borders to refined silver outflows. Policies barring raw bullion exports, implemented ostensibly to preserve sovereignty over strategic resources, now block 60 to 70% of refined silver that once supplied London vaults and New York clearinghouses. This break chokes the global pipeline at its primary source, transforming China from the world's dominant exporter into a massive absorber. Domestic industries like solar panel manufacturing and semiconductor production hoard metal for their own needs, leaving Western vaults exposed to cascading deficits with no alternative supply sources capable of filling the gap. Third system break. Institutional anomalies like the UBS SDIC fund collapse have signaled systemic panic rippling through investment channels. Trading at 62% premiums above net asset value before hitting 10% down limits, this regulatory intervention designed to curb speculation instead broadcasts scarcity to every market participant. The message is unmistakable. Even dedicated commodity funds cannot sustain their valuations without physical metal backing their paper claims. This break accelerates the drain on available supplies as speculators exit paper positions en masse, forcing prices higher in a self-reinforcing loop that amplifies the initial surge rather than dampening it. These three breaks do not operate in isolation or sequence. They interlock with mechanical precision, each feeding the others in a system that has lost all capacity for self-correction. Each component feeds the anomaly, elevating silver's $75 breach from a temporary peak to the market's new, inescapable reality. The breaks combine to create conditions where no traditional market mechanism can restore balance. There is only one real explanation that accounts for all observed phenomena. China's role as the epicenter of physical scarcity has overwhelmed the global silver system's capacity to balance supply and demand through price signals alone. With export restrictions locking in domestic supply for strategic industries, backwardation in Shanghai reflects literal physical shortages where factories demand immediate metal for photovoltaic production that now absorbs 29% of global silver demand. The UBS fund collapse is a symptom, not the underlying cause. The root is China's transformation from the world's dominant supplier to an aggressive hoarder, pulling refined silver inward while simultaneously cutting off outward flows. Geopolitical tensions like Venezuela's blockade and Japan's defense spending add distinct layers of risk premium, but they operate on top of the fundamental supply crisis rather than causing it. The certainty is absolute. The $75 price jump persists and will likely extend further because China's physical grip now dictates global terms, and the rest of the world's paper constructs have no counterforce left to impose alternative pricing. Paper forms the crumbling edifice of Western and global benchmarks. Layers upon layers of futures contracts, derivatives, exchange-traded products, and notional claims that expand without requiring actual metal movement from vault to vault. The spot price range of $74.46 to $75.14 in MCX futures at rupees 232,741 represent this illusion most clearly. These are prices held in place by promises and speculation rather than delivery obligations that anyone expects to fulfill. These instruments once preserved the facade of equilibrium across borders, allowing markets in London, New York, Shanghai, and Mumbai to operate as if they accessed the same underlying metal. Physical silver, however, asserts itself as the unassailable reality. The actual ounces that Chinese industries pay premiums near $80 to secure today, right now, for immediate delivery. The anomaly lays bare the chasm that is open between these two domains. Paper postpones, inflates through endless contract rolls, and ultimately falters under sustained demand pressure, while physical exacts the true cost because it cannot be conjured through ledger entries or duplicated through financial engineering. The system logs delineate this axis sharply and without ambiguity. Paper's fiction disintegrates in real time as physical scarcity enforces its dominance. The system logs show the horizon contracting swiftly, the window for action narrowing with each passing day. By early 2026, as Federal Reserve rate cuts materialize and solar installation demand escalates toward 500 gigawatts of annual installations globally, dealers note inventories straining under rationing protocols, with premiums over spot intensifying week by week. The data reveals the surge window, once open for price convergence and supply adjustment, is now sealing shut. Availability metrics across major exchanges are hitting unprecedented lows, with deliverable stocks falling to levels not seen in decades. The anomaly has bifurcated the terrain into two distinct domains. Those attuned to the physical imperative evident in China's pricing, who position themselves amid irreplaceable scarcity and secure actual metal, and those who remain tethered to paper frameworks, merely witnessing the price ascent escalate unchecked as physical stocks dwindle toward zero. Dealers report that acquisition interfaces are dimming progressively across all venues, with premiums widening and delivery delays extending. If these indicators are disregarded until the threshold passes completely, the schism between paper and physical solidifies into permanence. The mathematics, the breaks, the timeline, all converge on a single conclusion. The silver market has entered a regime where physical scarcity dictates terms that paper markets cannot override. China's export restrictions and domestic hoarding have removed the world's primary supply source from global circulation. Shanghai's backwardation signals that Chinese buyers will pay any premium for immediate delivery. Western funds collapse under the weight of their own premiums, unable to maintain valuations without metal. And through it all, the spot price at $75.14 represents not a peak, but a new baseline from which further gains will build. This is not a prediction. This is documentation of a failure already in progress, captured in the logs, quantified in the premiums, and confirmed by every metric that matters. The system designed to balance has instead fractured. The market that once self-corrected now accelerates its own disintegration. Subscribe and enable notifications to stay updated on the next system logs as these failures unfold in real time. Again, I'm Kevin Huang, and this is Markets in Context. Thank you for watching. If you found this analysis valuable, share it with someone who is still holding paper promises. We'll see you in the next one. Stay sharp, stay physical.